Kieran, can you tell us the investment process of our long-short strategy?
Absolutely. So the investment process is really about identifying those very few key winners. So as global growth investors, what we've got is thousands of companies we could invest in from all over the world. And many of those companies are growing mostly because GDP is improving, or Australia's terms of trade are improving, or Canada's terms of trade are improving. But they're growing because of those macro factors where we don't necessarily have an edge. What we've identified is a very small subset of companies that we believe are growing because of a structural change in their industry, i.e. one of those very few key winners that we're looking for. And so what we do to identify those potentially very few key winners is look for 6 really important qualitative tests for all of those companies. And so firstly, as a growth investor, clearly the company has to be growing. We like companies that can typically grow at least double GDP. Secondly, they need to be able to leverage that growth, so they need to have some degree of pricing power or competitive advantage where their earnings or their EBITDA is actually growing faster than their revenues. Thirdly, we like that growth to be sustainable over a long period of time. So there we're looking at things like how big the total addressable market is, or what is the volatility of the operating income or profitability over time. The next step is the ESG, and so we've developed an in-house ESG scoring process for all of the companies that we're looking for. And there we're looking to make sure the company is effectively a good corporate citizen. The last 2 characteristics that we're looking for are somewhat unique to the process, but we think really important and separates a growth investor from many other investors in the market. And so as a partnership business, we really value that alignment with our clients. And so what we're looking for when we invest is companies that have management teams that are highly aligned to their shareholder bases. And therefore, we're looking at things like how much ownership a management team has in their stock, or how are they incentivized. The last one is the customer perception of the product. So to be a great growth company, we think you need to have a great product. And so there we're looking at things like Google Trend data and review data to make sure the customer perception of the product is high. Once we've ticked off on all those 6 qualitative factors, that's when a stock can get into our small subset, into our investment universe, which we divide up into those areas of interest or areas of structural growth. The next step is graduating a stock from the universe to the portfolio, which is where we do that quantitative work. And so given our philosophy is focused around earnings growth, what we're doing is actually forecasting the earnings growth of all of our companies. And so what we hope to see is the potential for the earnings of our companies to double over a 5-year period. We're also looking to forecast a multiple that those earnings should trade on. So therefore, coming back to the philosophy, we're trying to identify, is the market mispricing the sustainability of this growth? And then lastly, we've got the whole world to look at for a growth investment. So we need to map out our investment case playing out in practice. And so we're looking for the catalyst to actually make this investment case happen in the real world. And so when we invest in a long position, we're looking to identify and tick the box on 2 out of those 3 quantitative tests. And for a short position, we hold shorts to a slightly higher threshold. And so they need to tick the box on the earnings downside, the multiple downside, and have a catalyst. And we're hoping for shorts to fall 10 to 20% within 6 months. So we hold them to that slightly higher risk threshold. The last piece of the puzzle in the process is potentially the most important part, but that's our risk management framework. And so internally, we identify, or we adopt a stop loss process, whereby if a long stock falls 20% from its cost base, or 20% from the peak price since we bought the stock, we have a formal review of that position. And if a short position rises 10% from its cost, we again have that formal review. And so it's important to remember that this is not an automatic sell of the position, but rather a reaction function for us to go away and check, have we made a mistake in forecasting those earnings or forecasting that multiple? Or have we got the catalyst wrong along the way? And so it's a way for us to check our investment case playing out in practice and manage those downside risks. By definition, if we're trying to identify the next big wealth generator for the market, we're naturally going to make mistakes along the way. And the stop loss process is there to help us deal with those mistakes.